In a dramatic development shaking North American trade relations, former President Donald Trump has announced a 25% tariff on Canadian imports. The administration cites border security, illegal immigration, and drug trafficking concerns, though the impact extends deeply into both nations' economies. The announcement has rattled international markets, with Prime Minister Justin Trudeau declaring, "Everything is on the table," signaling Canada's firm stance against these economic measures. Ontario Premier Doug Ford leads calls for countermeasures, suggesting bans on American liquor imports and potential cuts to energy exports to northern U.S. states. The situation is complicated by the integrated nature of both economies. American refineries in the Midwest and Rocky Mountains rely heavily on Canadian heavy crude oil. Experts warn that supply chain disruptions could increase U.S. gas prices while threatening Canada's oil-producing provinces. Meanwhile, China's reduction in U.S. crude imports adds another layer to the volatile trade situation. The timing of Trump's tariff announcement is particularly critical as global energy markets experience unprecedented shifts. Analysts suggest these North American trade tensions and China's energy strategy changes could reshape international trade patterns. The situation mirrors previous trade disputes where economic measures served broader political objectives. However, the level of economic integration between the U.S. and Canada is unprecedented. As markets prepare for potential escalation, the crucial question remains: will diplomacy prevail in this economic showdown, or are we seeing the start of a major disruption in North American trade relations? In a significant shift reshaping global energy dynamics, U.S. oil exports to China have dropped from 115.6 million barrels in 2024 to 81.9 million barrels in 2025. This reduction reflects China's evolving strategy in the international energy marketplace, driven by economic slowdown, renewable energy initiatives, and a pivot toward alternative suppliers. The situation intensified when China implemented retaliatory measures against U.S. energy products. Starting February 2025, Beijing imposed a 10% tariff on American crude oil and a 15% tariff on LNG and coal imports. This action has moved China from being the second-largest consumer of U.S. oil to sixth place. China has orchestrated a diversification strategy, turning to suppliers isolated from Western markets. Russia, facing international sanctions, has become a primary beneficiary, offering Urals crude at significant discounts. Iran has maintained its oil flow to Chinese markets through innovative methods. Chinese buyers have developed complex systems to continue importing oil from sanctioned nations, including disabled tracking systems and mid-sea transfer operations. Iranian oil shipments are often relabeled as originating from countries like Malaysia or Oman to avoid detection. While a 2% increase in Iranian oil imports might seem modest, against China's daily crude intake of over 10 million barrels, it represents a substantial volume. This strategic realignment is about China establishing greater energy security while reducing dependence on Western suppliers. This shift mirrors developments in other regions, where energy politics have become intertwined with broader geopolitical objectives. China's ability to leverage these international dynamics while maintaining energy security showcases Beijing's growing sophistication in global energy diplomacy. For American energy exporters, this realignment poses significant challenges, suggesting a broader transformation in global energy relationships that will influence international relations for years to come. In a significant shift reshaping global energy markets, China continues to demonstrate its masterful navigation of international oil trade, particularly through its growing relationship with sanctioned nations. Energy analysts reveal how Chinese refineries, especially independent ones, are capitalizing on discounted oil through sophisticated trading mechanisms. Recent investigations by Kepler and Vortexa have unveiled an intricate web of operations designed to circumvent trade restrictions. Using satellite imagery and ship tracking technology, these firms have documented various methods to obscure oil shipments' origins. The tactics are becoming increasingly sophisticated, explains analyst James Chen. We're seeing ships going dark by deactivating tracking systems and ship-to-ship transfers in international waters. Malaysian and Omani ports have emerged as crucial hubs, serving as relabeling stations for Iranian and Venezuelan crude oil before its final journey to Chinese refineries. While official customs records might not reflect these transactions, the volume increases tell a compelling story. This strategic approach serves multiple purposes for Beijing. Beyond securing cheaper oil supplies, it strengthens China's energy security while providing refiners with higher profit margins. These advantages allow them to offer more competitive fuel prices or dominate regional markets. The ripple effects are being felt across traditional oil suppliers. Major exporters like Saudi Arabia, Angola, and Brazil must adjust their pricing strategies to remain competitive against the discounted oil China increasingly favors. This transformation demonstrates China's growing influence in reshaping international energy markets. By leveraging its buying power and trading networks, Beijing is creating an alternative energy trading ecosystem that challenges traditional market structures and Western-led sanctions regimes. For the global energy market, this represents a fundamental shift in power dynamics, with China's decisions increasingly determining market directions and pricing pressures. In a significant reshaping of global energy dynamics, Russia's pivot eastward has yielded remarkable results amid Western restrictions. The transformation of Sino-Russian energy cooperation has become a defining feature of the new global economic landscape, with bilateral trade reaching $240 billion in 2023. The completion of the Power of Siberia pipeline in 2024 marks a crucial milestone in this partnership. This project provides China direct access to Russian natural gas, with expansion plans in discussion. These developments signal a strategic pivot away from European markets, making Russia increasingly reliant on Chinese demand. For Beijing, this arrangement serves multiple strategic objectives. Beyond securing energy supply from Russia, it represents a strategy to reduce dependency on Western-controlled markets. This diversification extends to Iran, where China procures crude at discounted rates despite American sanctions. China's Iranian oil purchases have provided Tehran with crucial financial support. Despite stricter U.S. sanctions in October 2024, Beijing maintains oil imports through various channels and masked shipping arrangements. The UAE has emerged as another key player in China's energy strategy, with bilateral trade reaching $95 billion by 2023. Energy remains fundamental to the relationship, with UAE gas exports to China exceeding $4 billion. The partnership between CNPC and ADNOC in 2024 underscores China's commitment to diversifying energy sources. This network of energy partnerships reflects China's approach to ensuring energy security while building strategic alliances. By cultivating relationships with multiple suppliers, Beijing reduces its vulnerability to geopolitical pressures while establishing itself as a central player in global energy markets. For Russia, these developments present both opportunities and challenges. While China provides a crucial market for energy exports, the increasing dependency on Chinese demand could limit Moscow's strategic flexibility. This eastern pivot will continue to define global energy dynamics for years to come. Breaking news on global energy markets shows China's ambitious strategy to reshape international power dynamics through strategic energy partnerships. Beijing's sophisticated approach aims to secure its energy future and establish itself as a central player in the global energy ecosystem. Industry experts note that China's rapid expansion in oil and gas production, coupled with increased trade in crude oil and LNG, signals a significant shift in global energy politics. This move comes as Western nations grapple with changing supply chains and evolving diplomatic relationships. China isn't just buying energy, they're building an empire, says energy analyst Michael Chen. By diversifying supply sources and strengthening ties with Russia and Middle Eastern nations, they're creating a network that reduces dependency on Western suppliers. China's reach extends into renewable energy as well. They've emerged as a dominant force in solar technology, with substantial exports to the UAE. This partnership is notable as both nations position themselves as sustainable energy leaders. The UAE, now China's largest commercial partner in the Middle East, represents a crucial hub in Beijing's influence. This strategy impacts global markets significantly. By reducing reliance on American oil supplies, China is altering long-established trade patterns. This shift comes amid unprecedented market volatility due to regional conflicts and changing diplomatic alignments. The ripple effects are being felt from Washington to Moscow and across Middle Eastern oil capitals. Traditional energy powerhouses must recalibrate their strategies as Beijing's influence grows. This transformation represents one of the most significant shifts in global energy politics since the 1970s. As we monitor these developments, one thing is clear. The global energy landscape is undergoing a historic transformation, with China increasingly holding the reins of power. Understanding these changes will be crucial in navigating the evolving economic and political